Hi, everyone. Thank you for joining today's webinar, Overview of Quantopian-Based Paper on Uncovering Momentum with Yulia Malitskaia. Today's speaker is Yulia Malitskaia. Yulia is a researcher at VKY Analytics focusing on multi-factor portfolio and factor investing. She holds degrees from NYU Stern School of Business, University College Cork, Ireland, and the University of Cambridge. Thank you so much, Yulia. With that, let's get started.
Thank you for the introduction, Saba, and thank you everyone for joining. The webinar talk I will be presenting today is Overview of Quantopian-Based Paper on Uncovering Momentum. The paper continues the study conducted in Momentum with Volatility Timing. In brief, the previous paper highlighted the broken momentum behavior during the crisis and proposed to apply realized volatility as a timing signal for changing strategies within multi-factor portfolios. At the same time, it refreshed the question rooted in the theory behind momentum. As you know, the explanation of the momentum premium continues to stir debate and remains an unsolved challenge addressed by multiple risk-based and behavioral models. Contributing to this field of research, this paper explores the momentum strategy following a systematic divide-and-conquer approach composed from a sequence of 4 steps, with each one representing a self-contained and complementary topic. To set the stage, the talk begins by outlining the main takeaways of each step. First, dissects momentum performance across market states and decile portfolios, suggesting that each case requires independent evaluation. Second, detaches the volatility scaling component from the time series momentum portfolio and identifies the momentum decile as a basic common block across alternative momentum strategies. Third, applies the combined in and out of sample momentum decile analysis, prompting a more asymmetrical version of the momentum definition, like Achievement Award for lucky winners. And finally, proposes to extend the scope of cross-section return studies with the analysis of temporal patterns by applying time series clustering. Then, the webinar is structured around this 4-step top-bottom approach, moving from the momentum factor and into the stock level. First, dissecting the momentum performance along bull-bear states and winners-losers deciles. Next, identifying the unscaled momentum decile as a basic common block across alternative strategies. Third, rolling the combined in and out of sample analysis. Fourth, clustering momentum decile time series. And lastly, the webinar will conclude with a summary. Now, let us begin with the top-level first step of the study, which analyzes the momentum factor across market states and deciles. A comprehensive background on momentum was overviewed in the previous Momentum with Volatility Timing paper. This slide highlights a few references across 3 topics. In 1993, the momentum effect was documented by Jigadish and Titman, who showed with US common stock data that buying past winners and selling past losers produced significant abnormal returns for the time interval from 1965 to 1989. Since then, as you know, there have been many papers on momentum and analyzing the effect across various assets, including country indices, international equity markets, industry portfolios, currencies, commodities, residential real estate, corporate bonds, and characteristic-based equity factors. With respect to the 2 papers cited here, Asness and team verified the momentum effect across 8 diverse markets and asset classes, while Gexi and Samanov extended the momentum effect analysis with stock data going back to the 1800s. In short, the studies have accumulated in the view that momentum is almost everywhere. Subsequently, the momentum strategy has since been implemented and modified within the industry, including index providers and mutual funds. At the same time, momentum strength and performance varies across the bull and bear market states. Therefore, Daniel and Moskowitz evaluated the individual behavior of the winners and losers portfolio components and separated the bull-bear states and up-down market phases. The authors found that during the upmarket bear state, the beta of the losers component was high, and consequently shorting the high beta losers contributed to momentum crashes. The figure here highlights the broken momentum behavior by showing how when the market, in yellow, began to regain strength after the 2008 downturn, the past losers and winners switched places. In other words, the losers outperformed the winners, as seen by the blue line that is above the green line. This trend reversal contributed to the momentum crash and occurred in the bear market, as documented by Daniel Malitskaia. In the momentum with volatility timing paper, it was shown that this broken momentum behavior coincides with the momentum volatility bump. Therefore, this section continues the study by dissecting momentum performance along two dimensions, including bull-bear market states and winners-losers deciles. The table presents the descriptive statistics spanning annual mean, annual volatility, max drawdown, annual alpha, and beta for excess market, the conventional winners minus losers momentum, and its corresponding top decile winners and bottom decile losers components. The results are reported for both the complete time interval from 1927 to 2019 and bull-only market states. For identifying market states, this paper follows the methodology of Daniel Malitskaia, where market states are based on the cumulative 2-year past returns, with non-negative values representing the bull state. According to this table and table 2 in the paper, momentum has a heterogeneous structural and temporal behavior depending on the decile and market state components. Let us begin with the top right component. Winners represent the solo driver, producing annual mean with positive alpha and beta greater than 1 during bull states. These results correspond with the table's W10 bull row values highlighted in blue. Losers in the bull state, in contrast, generate a small annual mean and as a byproduct of the difference between a negative alpha and beta of winners level. During the bear state, losers' alpha becomes positive and beta is increased. At the same time, the alpha and beta parameters of past winners are substantially reduced. Therefore, to summarize, this heterogeneous behavior suggests that each case requires independent evaluation, and the most unblemished case is represented by the winner's performance in the bull market state. The results of this section were conducted within the Kenneth R. French Data Library for the time interval from January 1927 to July 2019. This slide shows the corresponding Quantopian notebook. It reproduced the results for the recent time interval from January 2005 to July 2019 with the Quantopian Q-Tradable Stocks US universe and is used in the following sections. The notebook includes a few steps. Running Quantopian pipeline with the momentum and market cap classes for calculating momentum price scores and market caps respectively, and calculating forward returns and quantile rings with alpha lens. Then, defining the bull and bear market states, switching from daily to monthly data, building the value-weighted momentum deciles, and computing table statistics using the Quantopian empirical package. Now, let us look at momentum decile as a basic common block across alternative strategies. Momentum decile portfolio returns can be described by the standard equation, where each stock in the dataset is allocated to a portfolio based on relative prior performance and weights with one of the schemes, such as equally or value-weighted. This description is related with the time series momentum strategy, documented by Moskowitz, Oy, and Peterson in 2012. Similarly to the conventional momentum, this strategy is based on prior returns. In contrast with the relative ranking scheme of the conventional approach, the TS-MOM portfolio is formed from individual assets according to the sign of their prior returns, positive or negative. In their paper, the authors documented and demonstrated the strategy of 58 futures and forward contracts spanning from 1965 to 2009. Following studies extended this scope across multiple asset classes and time intervals. For example, De Souza applied the strategy to individual US stocks from 1927 to 2014. Hurst, Oy, and Peterson showed strong positive returns for over a century of data, covering 67 markets across 4 asset classes, 29 commodities, 11 equity indices, 15 bond markets, and 12 currency pairs. The comparison of conventional and time series momentum is addressed by several papers. One of the distinguishing features is associated with volatility scaling that is embedded in the weighting scheme, and it helped to bypass the market downturn. As shown by Baltas, time series momentum weights can be decomposed into a volatility scaling ratio and the weights of the volatility parity portfolio as follows. Barroso and Santa Clara applied the same scaling approach to the conventional winners minus losers momentum strategy and successfully demonstrated that the scaled momentum approach bypasses the 2008 market downturn. Scaling, however, provides only a partial solution. Therefore, the volatility timed winners approach proposed to replace scaling with a threshold function and treat realized volatility as a timing predictor for changing momentum strategies. This approach is consistent with the dual momentum strategy presented by Antonecci using the market prior for changing from index to treasury bonds. The second step of the study follows the threshold approach by detaching scaling from the momentum effect for comparing and analyzing unscaled momentum strategies. In this table, we see the comparison of the unscaled cross-sectional momentum and time series momentum strategies. Specifically, the winners W10 and losers L10 deciles versus the positive and negative components. Similarly to the previous section, the table includes 5 descriptive statistics covering annual mean, annual volatility, max drawdown, annual alpha, and beta. While the previous table spanned from 1927 to 2019, here momentum performance is evaluated on recent data from 2005 to 2019. Again, we have results for both the complete and bull-only time interval. Overall, there are 2 main observations from the table. First, within this recent 2005-2019 interval, the gap between the W10 and L10 betas increased, affecting the performance and hedging of the conventional winners minus losers. As a result, Pappas and Dixon document that multiple institutions have transitioned to long-only momentum strategies. Second, the performance difference between cross-sectional and time series momentum strategies lies in the TS-MOM construction, which is built from a weighted sum across all deciles, rather than just the top-bottom portfolios. The decomposition of TS-MOM positive and negative components reuses the same momentum rankings and then normalizes the weights. The table shows the performance of time series momentum decile portfolios. Specifically, the correlation between cross-sectional and time series momentum, mean and standard deviation of decile weights. And if we zoom in on the weights mean results, we see for the top deciles that most of the weight is concentrated in the positive component and virtually non-existent in the negative component, implying that the top-ranked stocks are stocks with positive prior returns. On the other hand, vertically assessing the bottom deciles demonstrates that a main proportion of stocks in these deciles have past negative returns. As a result, the weighted sum of the positive negative deciles can be further approximated with a sum of top-bottom momentum deciles. Subsequently, the above relationship identifies the momentum deciles as a building block of the TS-MOM positive and negative components. Therefore, the recent development of momentum extensions led to the dual strategy, complementing the relative momentum ranking with an asset prior threshold. From the general perspective, the dual strategy establishes a common framework covering multiple strategies. Working off the established framework from the previous section, this Quantopian notebook transitions from the cross-sectional momentum strategy and to constructing and evaluating time series momentum with a few steps. Building value-weighted TS-mom positive and negative components by replacing factor quantile with factor sign in the selection criteria, and computing the corresponding statistics with Quantopian empirical package. In addition, the notebook outlines the calculation of value-weighted TS-mom decile weights. Here in this section, we move down to the third step, which involves conducting an in and out of sample momentum decile analysis. As already mentioned, the explanation of the momentum effect introduced a challenge for the efficient market hypothesis and risk-based models. Therefore, the rationale behind the momentum strategy was mostly addressed by behavioral theories, involving the over and under reaction of investors to new information. The models span multiple categories, and of course, this list is not complete. Within the category of psychological biases, Barbaros and team proposed the consolidated model of investor sentiment based on two psychological regularities: conservatism and representativeness. According to this model, conservatism explains underreaction to information, and the representative heuristic may lead investors to overreact to a consistent sequence of good and bad news. Daniel and team, on the other hand, derived an alternative integrated model using a different set of psychological biases: overconfidence and self-attribution. As shown by the authors, the investors' overreaction to their own private information and underreaction to public signals pushed up the prices and hence prompted the positive short lag and negative long run autocorrelation in stock returns. The second category with multi-agent models is primarily associated with Hongenstein. They complemented previous models driven by representative agents with the interaction between heterogeneous agents, news watchers, and momentum traders. Within their model, news watchers made predictions based on their private information while ignoring current or past prices. In contrast, momentum traders' strategies were limited by the history of past prices. Then, when the private information diffused gradually across news watchers, momentum traders could profit from the price underreaction to news in the short run. The model based on the disposition effect is rooted to prospect theory, the mental accounting framework, and Sheffrin's statement. They coined this corresponding anomaly related to the tendency of investors to sell stocks increasing in value too soon, while holding on to stocks decreasing in value for too long. While the momentum application, Greenblatt and Hahn showed that the corresponding investor behavior led to unrealized capital gains driving out returns. And later, Da and team proposed the frog in the pane hypothesis, suggesting investors underreact to information that comes in continuously and in small amounts due to limited attention. This paper explores the momentum effect from the data-driven empirical direction, beginning with a combined in and out of sample portfolio analysis. The figure here presents to the corresponding box plots for the top decile summarizing the monthly distributions of portfolio returns over the in and out of sample intervals. Tables B1 and B2 in Appendix B in the paper complement the figure with quantitative results for winners and losers, encompassing the annual mean, alpha, and beta parameters. In short, the approach rolls a family of decile portfolios having the same stocks and ranking intervals, but different one-month holding periods. The approach extends Quantopian pipeline that is described in the first section with additional steps. It includes running and evaluating portfolio with 1 month forward returns during the combined 12-month in and out of sample intervals relative to the momentum formation date. The box plots highlight the bump between the ranking and holding intervals. As you know, many studies are primarily dedicated to analyzing the holding period. These plots switch our attention to the construction time, or at least the first few months. The bump can be explained by sampling, independent and identically distributed stocks. According to the IID model, momentum effect, however, should be zero, but it is clear it is a product of the sequence of lucky winners. In any case, the difference in performance between the ranking and out-of-sample intervals prompts clarification of the conventional momentum definition, such as winners continue to win, with more accurate asymmetrical versions like lucky winners accumulate an achievement award. The small price of this award does not represent a challenge for the efficient market hypothesis and defines a criteria for assessing the underlying momentum theories and models. The slide shows the rolling in and out of sample momentum time series for the bull market. The corresponding function consists of an outer loop and two inner loops. The first inner loop selects an intersection of tradable stocks spanning the in and out of sample intervals. Then, the second inner loop calculates the value-weighted returns in every month of the in and out of sample interval. The outer loop rolls both inner loops across the defined time horizon. After rolling this function, the corresponding portfolios are shifted to adjust with the market time series for the calculation of alpha and beta. Now we delve into the stock level and apply clustering for grouping stocks with common in and out of sample temporal patterns. Transitioning to the stock level connects the analysis to studies on momentum returns and firm characteristics. These characteristics can be interpreted as proxies for information uncertainty and are generally related with behavioral models. The list of characteristics here is not exhaustive and includes size, R-squared, turnover, age, analyst coverage, forecast dispersion, book-to-market ratio, illiquidity, and credit rating. For example, as shown by Jigadish and Titman in their original momentum paper, momentum profits are higher among smaller stocks. According to Ho, the momentum effect is more prominent for low R-squared stocks. And Lee and Swaminathan demonstrated that companies with high past turnover have higher momentum returns. In 2011, however, Bondarchuk and Hilscher demonstrated that characteristic interaction patterns are the result of more extreme past return sorts. Then, though, Mueller and Mueller conducted recently a study with 18 characteristics across 14 countries. And as a result, the authors demonstrated the relation of characteristic to momentum profits even after controlling with extreme past returns. This paper proposes to extend the scope of past studies by the analysis of stock in and out of sample temporal behavior and switching from the analysis of the right side independent variable to the left side dependent variable. Similarly to the previous section, the approach begins with ranking stocks by priors and collecting the 1-month forward returns across the 12-month in-sample and out-of-sample intervals relative to the formation date. In contrast to the portfolio-level version, however, the corresponding stock-level analysis deals with the time series individually collected for each stock. The stock-level time series of ranking and out-of-sample intervals can be further classified with parameters calculated from the linear regression, where R is the stock return observed at month M. The distribution of the ranking interval was further split into 4 clusters based on the k-means multivariate approach, where clusters are calculated with the k-means approach based on the ranking interval P0 and P1 parameters as inputs. The figure shows these 4 plots, what the cross-sectional stock return means and standard deviations for the top decile portfolio, and the time window covers the 11-month ranking and 12-month holding periods. The subplots in the figure confirm and elaborate the results from the previous section. In general, temporal patterns can be described by the sampling of the momentum strategy. At the same time, they complement the in-out difference matrix with the fine-grained clustering technique for testing underlying momentum models. The corresponding Quantopian notebook is posted and available on the Quantopian forum. In summary, I would like to highlight the following 4 outcomes of the presented layer-by-layer analysis. Dissecting the heterogeneous momentum behavior across market states and decile portfolios suggests that each case can be associated with different processes and hence requires independent evaluation. Detaching the volatility scaling component from the time series momentum portfolio identifies the momentum decile as a basic common block across alternative momentum strategies. Combining the in-out of sample momentum decile analysis highlights the difference in performance levels between the 2 intervals and prompts a more asymmetrical version of the momentum definition, like Achievement Award for lucky winners. Applying the in-out of sample time series clustering aims to extend the scope of momentum studies with the analysis of temporal patterns. In addition, these 2 slides outline the references for this webinar. They are in alphabetical order, and most of them are also cited in the paper. And with that, I would like to thank everyone for joining and open the floor to any questions you may have.
Okay, everyone, we are now going to move into the Q&A portion of this webinar. I will be picking questions from the live chat and Yulia will answer them. So if you have any questions that you would like answered, please post them in the chat now. Thank you. Yulia, one of the questions asks, what is the x-axis on the last slide?
The x-axis is the ranking interval and then the holding period. So the 0 represents the portfolio construction date, and then the 12-month ranking interval lagged 1 month, and then the 12-month out of sample holding interval.
Another question asks, have you found any Hurst coefficient correlations with your time series analysis?
I will look into it.
Since there are no more questions, we're going to wrap up the Q&A portion of this webinar now. If you have a question for Yulia that hasn't been answered yet, you can post that question in the comment section of the forum post for Yulia's paper, which is linked in the description of this video. You can subscribe and press the notification bell to be notified when a new video is posted. Thank you for watching, and thank you, Yulia, for presenting a great webinar. Have a great day, everybody.
Thank you.